let's see, where do we start? So I wanted to start basically with how to find deals. And yeah, so I got my whole family in the background, I guess, finishing up dinner, so it's perfect timing. So the way I found this particular deal was LoopNet, which is really funny because the funny thing about LoopNet is they say this is where deals go to die. But I saw this one in Hagerstown and I was looking into it, and it was like, wow. And then I did the underwriting using software, Michael Blanc's underwriting software that he has. It's just a spreadsheet, but it's very sophisticated spreadsheet. You could almost call it a software. But it's a deal, Michael Blanc Deal Analyzer. He has it for free. If you just Google that, you can find it. Highly encourage you to check it out, actually, if you are looking at deals, because it's a very good way to plug in numbers to see if it even makes sense. I analyzed, I don't know, a couple dozen deals over the last, before I bought this, it was probably a year and a half. Prior to that, I just looking at all these deals, it's kind of learning with Jens. He was teaching me how to analyze deals. We were just actually finding real deals. So you can see the LoopNet screen, I'm assuming?
Yep.
Okay, cool.
Were you just focusing on the area that you have encircled, or were you looking at other markets as well?
You know what? That's a great question. I was actually looking all over. Cleveland and Columbus are very interesting markets to me. So I was looking a lot in those, and then I'm like, well, why don't I just kind of look around where I'm at? So I chose the 81 corridor here, and I thought, well, if I can drive to it, that would be even better. And that's kind of when I stumbled upon this one. And I was actually, I wasn't really, and that's kind of what you learn. You have to be market agnostic. Like, it doesn't really matter where it is, as long as it makes sense, right? So I was looking pretty much everywhere that I could kind of drive to reasonably. Did a lot of research in Philly, found that the prices are way too high. It's really hard to find anything that makes sense in like these metropolitan areas, Washington, Baltimore, Philadelphia. Same with Pittsburgh. I was looking over there. I thought, well, big cities, you're bound to find some good properties, but it seems like the major metropolitan areas is where the big guys go. Basically, there's a lot of capital that floods to those known markets, but this Hagerstown market is kind of a tertiary market. And so that's what I kind of refocused on. And that's the same with like Cleveland, Columbus area. They're not super popular markets. The cap rates are reasonable there. Problem that I saw when I was analyzing those markets, though, and I highly encourage you to actually analyze the market by digging into what the job, what the demographic is, the job demographic, and all those things. And I'll go into that here a little bit, since well, Ted's heard a lot of this already, but you guys are kind of new to this deal. But I'll go into the investment packet in a little bit and show you kind of what we did to dig into the markets. But so I started to dig into markets that weren't in these major metropolitan areas, and reached out to a lot of the so if you go into a lot of the brokers, so over here you find these guys on the right side. So I would just call them up, and I called dozens of brokers all over kind of the East Coast to get an idea of what they were seeing. And very few of them had much at all that made sense, but they would send me deals. I would underwrite them, pass on them, and that was kind of the process that I went through for, it seemed like forever. But that's a way. I mean, this actually, I actually underwrote this deal. Kind of funny, but and I'll even tell you kind of about this. So I like this deal. This is 21 unit apartment building, but it's actually not 21 units. It's actually like 30 some units, and some of them are privately owned, and then 21 of them, the development company started to rent them out. They built it in 2010, kind of at the worst time in history to try to sell anything. And so they started to rent them out, and they're leased out, and they're beautiful, beautiful units. They're like A+ class units, and they haven't raised the rents in 11 years. And I'm like, wow, that seems like a really good opportunity, and that's kind of what they focus on in the description. But it turns out if the property has privately owned and also leased out properties, I ran it by two of my lenders, so two of the banks I've been working with, and they both came back and they're like, yeah, we don't like this. The cap rate's too low. We understand that it's, you got to get the rents up to market, but there's HOAs. It's all kind of split up, and they were only willing to give me a 65% loan on it, and they wanted $6 million for this, I believe. So the raise would have been too much, and the terms weren't very desirable. So it was a good learning experience, and this was literally last week I was looking at this one. But anyway, it doesn't fit their box. So you're looking for properties that kind of fit what the lenders are looking for. This one seems interesting to me, and it's been on the market for a while. I did inquire about this like a month or two ago, and nobody ever got back to me for some reason. So I don't know if it's under contract, but yeah, it's a good way to find deals is find deals that you're kind of interested in, but then call the broker or email the broker. You can go here and submit this. I always customize this a little bit, kind of like, hey, just closed on a 27 unit, or, I have a couple rentals we're looking to expand, or, just something that they'll get back to you. But reaching out to them and creating a list, and just literally you're sort of selling yourself, but contacting them. So that's really a great way to find deals, I've found, especially your first deal. So, all right. That's kind of 101 on that, in terms of finding deals. You guys have any questions?
Hey, Jason, sorry to interrupt you. David said he's in the Zoom. He said he's waiting for the organizer to let him in.
Oh my gosh, sorry. Oh, I can't find the... Oh, I can't find the window. I have too many windows open. Oh, sorry, guys. I literally can't find the other part of my Zoom. This is crazy. Oh, there we go. I have to stop share participants. Oh, there's David. I guess when I'm sharing my screen, apparently I can't let people in. That's unfortunate. Hey, Dave.
Hi, Jason.
Hey there, sorry about that. I was sharing my screen and apparently Zoom doesn't let you see the people that are waiting to come in. So I'm sorry about that.
Not a problem.
How are you?
I'm doing good. How about you?
Doing great. We have a rock star in our Zoom meeting tonight. That's awesome. Thanks, Dave, for coming.
You're welcome.
Right on. So I was basically just going through kind of how I found this last deal, and basically I found it on LoopNet. And I was just explaining about how to look on LoopNet to find deals in your criteria, and you know, I can actually go back to that real quick because what I've found here, I'll share my screen again. What I've found is like my filter recently, I've been just focusing on trying to, so originally I was focusing on 50 to 150. There's a flood of money coming into multifamily currently for lots of different reasons. And so what I found is there are probably more opportunities in the 20 to 50 or 20 to 100. So that's kind of what I scale my my target to when I'm looking on here or looking on Reonomy. I've been using that. I'm going to send out a mailing to owners to find deals, but and then you can use this draw feature and kind of get your area. So I like this I-81 corridor, and that's where we found this past deal was in Hagerstown. This one happens to be in Hagerstown as well. What I understand from the property management company that I hired to manage the 27 unit that we just built is that we're in what they call the county, which is way better than being in the city, because there are problems that you'll find in the city that you'll find in a lot of cities, opioid problems and things like that. And it's just a little harder to manage something in the city than it is in the county. So it was, that was kind of eye-opener. I'm really glad I talked to, we interviewed 3 different property management companies for this property. So, all right. So any questions on LoopNet or finding deals or how I did any of this? Pretty easy to figure out, but I kind of like you can just select multifamily in here. I like self-storage and mobile home parks as well. Like the one we bought, which I'll show you in a minute here, is also a mobile home park. And make sure there's nobody trying to get in. I'll share this as well. So this is the
yeah, I guess that would make sense to make sure.
this is the investor packet that we put together, and you can see for the I guess probably Ted's the only person really familiar with this, but there are 6, 7, 8, 9 there's 9 mobile homes, and then there's 3 single families, or 4 actually. This is like a 2-bedroom, a small one, and then there are 12 of these efficiency units. It used to be a roadside motel, and I think the reason that it did sit on the market for a while is because of the fact that it is kind of an odd property. But the numbers made a ton of sense when I ran them, and that's why we pursued it and ended up buying it. But these are the numbers at a high level. So the purchase price is 1.25 million. We raised 450,000. So and then we got bank financing for $935,000. So it was a 75-25 loan from a local bank, Bank of Charlestown, which was, and they loved the deal. It was, I contacted a lot, probably 5 different banks, Members First, First National Bank, Bank Charlestown, 2 other banks in the Hagerstown market, and this bank just loved it. They loved the deal, and it felt like I was interviewing them at one point, which I think is kind of different. I don't think that often happens, but yeah, they really helped me analyze it too, which is one of the other things that I was surprised of. They have their own way. I had already analyzed the property. Mick and I, did the numbers. Mick is was his master's in finance, so he's really good at numbers. I like numbers as well. I like spreadsheets, and so we literally tried for a couple of months try to figure out a way or a reason not to purchase this property. But when it came down to it, we had a good cap rate at purchase, so 7.5 cap at purchase is pretty good. That it's something that I haven't seen. Most of the properties I was looking at up until this one, you're looking at between a 5-6 cap, very few 7 caps. And it's funny, like 10 years ago, so you wouldn't even look at anything unless it was a 10 to 15 cap, right? Right, Dave? And it's just like there's so much money coming in that the costs is being affected by it, the prices people were willing to pay. So average annualized return, and these are all very conservative numbers, we feel, at 16%. We think at the end of 7 years, the investor return on this deal will be about 2.2x. So if somebody comes with 50,000, they can reasonably expect to a little over double their money. The limited partner, general partner split. So Mick and I are the general partners on this deal, and so we're 20% owners, and the limited partners are 80%. The limited partners do nothing. We're also limited partners, so we actually invested in the deal alongside of all the limited partners, and we're going to do a cash out refinance. We anticipate our projected amount that we're going to be able to return to our members is 70%, 71%, somewhere in there at year 5. And I would really like to do that sooner if we can. So the idea is to get the rents up to market as soon as possible. This property historically has been 100% occupied. It's very desirable area to live in. Their C-class properties are affordable, and there are tons of logistics jobs in this area, which is like the demographic for this type of property. And all of the units have no deferred maintenance. So the previous owner was very diligent about fixing anything that needed to be fixed when it needed to be fixed. So when you walk in the property, all the roofs are good, all the siding's good. There's no like chipping paint. There's you walk through the units, most of them have newer flooring, newer backsplashes, the countertops, some of them are granite. It's a little, he really took pride of ownership in this building. He would remodel the properties as if he were going to live there. Probably a lot more than a lot of landlords would do, but he really took pride in this property. And as we were walking through it, we're like, wow, this is pretty incredible. So the tenants there, as a result of that, they stay for a long time. And they had a turnover right before we bought it. Somebody moved out, and they had it rented in less than 48 hours, and they had like 7 or 8 applicants. So there's a huge demand. That was the other reason that we really like this area, this property. I wish there were more of them, but there don't seem to be many of them. So what I was saying earlier about the market, so we did a lot of market analysis to make sure that the jobs are going to continue to be there. So Amazon just built a 1 million square foot warehouse. Literally, you can almost throw a stone and hit it from this property. And they're bringing in a whole bunch of new jobs, and it's a logistics, so a trucking and logistics area. We hope to get the cap rate up to about 9% once we get all the rents up to par. So the previous owners were really softies. They had they loved their tenants, like all of them. They would do whatever they could to help them out. And so they didn't keep their rents up to market. They just felt bad. They were making, it's a family. They're making pretty good money. I think it brings in 16 or 17,000 a month. That's pretty good income. If you own this, the family's owned it for 50 or 60 years, so it was pretty good income for them. They wanted to retire, so that's why they sold it. So this is kind of when you look at analyzing a property, you're going to see something like this. And, I wanted to do this to kind of show people, Mike, Brian, Ted, even Dave, if you're out there looking, I mean, David's written a book on this, but maybe not syndication so much, but like analyzing properties. But I was hoping to provide value with this and give some insight on what you're looking for when you do analyze a deal. So what we want to see is what the current rent is, and then what we can get that rent up to over time. Like I said, all the units were there was no deferred maintenance. One building does have some deferred maintenance because the people have been living there for 16 years. And so they're going to be moving out. So we'll have to, obviously do the normal things, go in and paint it and things, maybe some new carpet, but otherwise, like, nothing really needs anything. So the big opportunity here was to raise the rents to what the market is. So like I said, we had handful of property management companies walk through it with us when we were in our due diligence period, and they all agreed that we should be able to get the rents up from like 16,000 a month to like 21,000 a month. And what that does, if you understand cap rates, is basically the value of the property is based on the income of it, so what it produces. So hopefully, our plan is, and we haven't seen much resistance at all. Property managers have, already shared with tenants that, with people that are moving out, we're encouraging them to move out because they're on a month-to-month lease, and we know we can fill it quickly and get market rent at that point. So that's going to make there's at least 2 of those situations going on, but then just gradually bumping up the rents to what the tenants already know is fair. They already know they're paying way less than market right now. So yeah, so we did a lot of research into the geographic location, what's around there, what other so we have some of the units, so to speak, are pads that the tenant owns their mobile home. So we we found out that those are a lot less than they should be. Yeah, I guess it's not itemized on here, but I think we're getting like 325 right now for the mobile home pads, and we should, or no, 399, and we should be getting about 450. So that's an easy one. People don't even notice that, you know. So there's Brian. So yeah.
Yeah, I was gonna chime in. Are some of the mobile homes then owned by you and some are just the pads? Is that how that is?
Yeah, exactly. So over the years, it wasn't the plan of the previous owner, but people would just move out and leave the mobile homes there. So he acquired some of them and has renovated. Just in this last year, I think he renovated 3 of them. So they're basically like brand new inside. But yeah, we own. What is the breakdown? I should know this off the top of my head because I spent so much time analyzing. Yeah, there's 6 pads that we rent, and then the rest of the mobile homes. So there's 4 mobile homes that we own, and then there's a double wide as well. So 5 mobile homes.
Do you have a long-term strategy? Like, is your plan to kind of get them to tenants to buy them, or would your plan to be continue just to rent them?
I think it's going to be the opposite. We'll probably buy the mobile homes that are there as those tenants move out. The previous owner was actually fixing some of them up for the tenants that own them. So in anticipation, I think he's like, oh boy, I'm going to probably be stuck with this, so I better take care of it, type of thing. But yeah, I mean, that mobile home parks, I have a couple buddies. They're like, the idea is to not own the mobile homes, right? So, but in this case, I think it's probably going to be kind of the opposite because you can't even move them really, you know. So they're just probably going to stay there forever until you tear them down. And our plan over the next year or two, and we don't know for sure that we can do this, but the zoning would indicate that we probably can, but to add either some modular homes that we can rent or add additional mobile home pads, because it's a big property and there's a lot of room. So right back here, I don't know if you can see my cursor, but behind this left side, we could put something there. We're thinking that we can probably put something in the front here. This is a single family house. We can probably put something to the right there in the front of that. You could probably put 2 more of these little efficiency units there. And then in the back here, somebody that was thinking of buying it, they were going to put townhomes back here. So there's enough along that tree line in the back to the right that you could potentially do that. So what I'm thinking should be a pretty minimal investment unless the cost of building materials continues to go up. We should be able to increase the number of units on the property, and as a result, improve the value of it significantly. So that's one strategy that we're thinking, in addition to raising the rents, you know. So. This is comparables that we ran just to make sure we were on the right track with our targets to the rents. This is a population, income, house value growth report put together. And of course, the financials, one of the most important parts that the investor wants to see. And I can go through these, or if there's questions, I can let you look at those. But year 1, you're seeing maybe a 6%, but then it dramatically jumps up. And then at the refinance, then at the sale, you're at 64. I mean, just crazy numbers. And we felt like we were very conservative because we added in a 10% vacancy, 10% concession, loss to lease concession, when in reality, I doubt we'll ever see that type of vacancy given the history. And we may see some loss to lease or people moving out or whatnot. But even through COVID, I think they had maybe one or two tenants that got a little behind. It really wasn't an issue. People were still working in this market, at least. I know that's not the case in a lot of markets, but in this market, there were still jobs that, for, Amazon shipping and all those jobs, they needed to be done regardless of COVID, so people were still working. And a handful of the tenants there also are on fixed income, retired or whatnot, but they also know that they're paying way less than market and they can afford a slight increase. Anyway, we did a little SWOT analysis here as well. I can go down through that, but you guys have any other questions? You want to talk about anything related to this deal or any other deals that you're looking for, or be happy to go around and kind of see where you guys are at and what you're looking for. Smaller properties, would you be interested in looking at larger properties and partnering? I think that's the best way to leverage. I have some single families in our flipping company. We have some rentals, but it seems so hard to scale. And when you can pull money from other people, like we did with this particular deal, I think you can get a lot further, a lot quicker, and do a lot more deals and scale. That's why I love this business so much, is that you're able to scale it. Any comments, guys?
Hey, it's Mike.
Hey, Mike.
Can you maybe describe a little bit about the difference that one would experience if they are, like, the difference between the money that they get and also the control they have over the deal if they're going in as maybe like a limited partner as opposed to a general partner? And can you kind of enlighten me a little bit on that?
Yeah, so I'll go back to this. So that's a great question. And the way I look at it, a lot of people want to get into real estate. They think it's a great investment, but they just don't know where to start. They really don't like the idea of managing people and fixing toilets and trying to get the plumber there or whatnot. In my opinion, this fixes all of those problems for an investor that has capital, that knows real estate is a great place to put their capital if they can find the right deal. So syndicators like myself, operators, we're looking for these deals all the time. We're analyzing them. We have multiple sets of eyes on them. We've learned the business, and I feel like if you had $50,000 and you wanted to invest in real estate, and you really haven't really done it too much, maybe you bought a duplex or something, you could take the $50,000 and put it down and buy a maybe what's the math on that, David? Maybe $300,000 property. Maybe that would get you 3-4 units, maybe. You could probably, then you could qualify for regular Fannie Freddie financing on it. So that would be good. It's under 5 units for under And then you have, 4 toilets, you have 4 tenants. Whereas this, you take, and then maybe your cap rate in this market, around here, I think you'd have trouble finding something for better than a 7.5 to 8.5 cap, unless you're going to put a bunch of money into it. And then where are you at with your purchase? So it just seems like the easy button for me, to find syndicators. And then maybe it's not me, and I can introduce you guys to lots of other syndicators. I know a lot of them because I go to a lot of events, I meet a lot of people, and I'm on a lot of people's lists. And I if you'd like to get involved in any of those deals, that's great. I just think that a syndication is probably the best way, in my opinion, to invest a specific amount in a deal that you trust the operators. That's a big thing. And you can see the numbers. It's very transparent. You know what the business plan is, and maybe invest in 5 to 7 years and you double your money or better, and then do it again. People, I know a lot of these operators, and the investors, they're like, well, I don't want my money back. Just put it in your next deal. Keep doing that for me, because you have money sitting around that you weren't going to use anyway, but you want to put it to work, and that's why I think it's a great opportunity that a lot of people don't know about, and so introducing this to people is kind of my passion to provide that. Does that answer your question, sort of?
I think it does. But to clarify something, so if you're going in as a general partner but a limited partner, that's when I'm saying, hey, I have this cash, I trust you, I like the deal you're looking at, sign me up, essentially, right?
Yeah, exactly. So at that point, you're like, okay, I'm in. You get private placement memorandum, which is a long document with a lot of legalese in it, trying to talk you out of committing to the deal, basically, is what it looks like. And you have to agree to that. You wire the funds, and that's it. We have a attorney that files it with the. This was a 506B exemption, meaning I can take money from non-accredited investors. Do you guys know what accredited and non-accredited is?
Yeah, I mean, I do, but yeah.
Okay. If you all do, I won't go into that. But anyway, that's the way we structured this one. And so, yeah, that's basically it. I mean, we have Syndication Pros, the software that we use to onboard people. So you get to see the deal. You DocuSign the agreement in there. It allows you to, shows you how to get the money over, wire it, or through ACH. And then, yeah, that's pretty much it. And then we do quarterly distributions for the rents.
So 2 questions about that then. And one is just a clarification. So then as a limited partner, a person wouldn't have like direct control. Like, let's say, I guess the closest parallel would be like stocks and everything, where you have a stock investor, they put their money down, they don't have direct control in the day-to-day operations of the deal, right?
Yeah, correct. Yep. You really don't do anything, except for, kind of follow along. We send out updates, but yeah, that's a different, limited partner, you invest in a deal passively. And
Okay.
The general partners, what we do is sort of manage the managers. That's kind of our job, and look for opportunities to improve the asset in any way. Like I was saying, we're looking at opportunities to expand the number of units on this particular property, which there seems to be good opportunity for that. And strategy, we're sort of the strategist working with the property management company who handles the day-to-day.
All right, and then the last question was, what would be the time frame on how long it takes you to kind of like repay the initial investment? And then I think you already kind of mentioned it, but beyond rents, is there any other way that you pay back the initial investors?
So to answer your question, besides rent, so what we're doing by raising the rents is creating more value in the price. So the property will be worth more based on the amount of rents we're taking in. So then what we do is we go back to the bank and say, okay, now this is our rent roll. Now the property is valued at this. We'd like to do a refinance, and then we pull money out at the refi and give it back to the investors. So that's another way. So and you also have depreciation. So as a passive investor, it's as if you bought. I mean, you did buy a portion of this property, so you get depreciation if you need it, depending on, you have to ask your tax professional. But we have opportunities to take depreciation as well to offset your income. So that's another really attractive aspect of syndications versus if you would just go to buy a REIT, real estate investment trust, which is essentially a stock in a company that buys real estate. You don't get any of those benefits that you get in, as a passive investor. You essentially are buying the real estate alongside of everybody else. So what was the first part of your question? I'm sorry.
I think you covered it all.
Okay.
I mean, I'm familiar with a couple of the concepts you're talking about. I'm just not familiar with the syndication application of the concepts you're talking about. But I mean, it makes a lot of sense.
Cool. Yeah, syndication is all it means is that we're raising money legally. So you can go to a bunch of your buddies and say, hey, we're buying this property, give me 50 grand. You put it on a bank account, you go closing, and you buy the property. People have been doing that for a long time. Unfortunately, that's not legal. So, and a lot of people don't know that. So the reason that we hire an attorney and pay him like $10,000-$15,000 to set this up is so that it's done in a way that the SEC acknowledges that you're raising money in a legal way. So you're filing an exemption, meaning that you don't have to register this as a security, because that is cost prohibitive. I mean, you couldn't security. If you're registering a security, it's, I think, hundreds of thousands of dollars to do that. So you're essentially filing this with the SEC. Say, hey, I want an exemption. We're not. This isn't a security. We're doing the syndication model, and so the attorney just has to draw up all the paperwork, which is essentially the PPM, the private placement memorandum, that notifies you in a legal way that this and this and this and this could go wrong, and we just made it's disclosure after disclosure, like anything in real estate. I'm also a real estate agent, so we have a ton of those disclosures as well. It's essentially the same thing, but yeah, that's kind of the difference between raising money that's not compliant with the SEC versus doing the legal syndication model.
Thank you. I appreciate it.
Yeah.
It does make a lot of sense, actually. Yeah.
Yep. So yeah, I try to do things legally. I don't want to go to jail or be fined. I'm in the business of not losing money. That's my most important goal. Not lose money and make lots of it. That's what I want to do. So, well, yeah, that's kind of what I had. Anything else? Brian?
For this particular deal, did I see you're looking at actually selling in year 7? Is that?
That's the plan. Yeah, we'll see. And the plan is to refi at year 5, but the way it's going, I'm going to push to do that a lot sooner. I'm going to get the rents up to where we can refi as quickly as possible. I don't know where interest rates are going. That's my pretty major concern. I was just at an event in Miami this past weekend called Rebel Capitalist Live. George Gaiman,
Oh, yeah.
Rebel Capitalist show. You guys
Yeah.
ever hear of it?
Yep.
Yeah, fantastic. I love that guy.
Yeah, he's cool.
I did. What's that?
Yeah, he's good.
He's really good. Yeah,
He does the whiteboards or whatever.
yeah, the whiteboard videos. Yeah. I gave him a shirt. I got in the t-shirt making business because I, over the last year and a half, was just lamenting on the couch about all this stuff that's going on, and came up with these funny ideas. But I made him a shirt. I gave it to him. It says "Cerveza sickness related?" and has like the same font that's on the Corona bottle with the Corona logo above it. Anyway, yeah. But yeah, I was at that this past weekend, and now I lost my train of thought. But
Interest rates.
interest rates, yes. There was a lot of talk that we're probably going to see interest rates probably go up. It may not happen, and the Fed may try to keep them down, but it may happen. So I'm just going to try to plan for the worst. And, so if they do go up, I don't think it's going to be drastically, but I also don't want to be at year 5 and, the interest rates went up different than we expected. But we were also conservative on what that was, and we got a way better interest rate than we thought on this particular loan. So I'm not too concerned about it. I just like to be as conservative as I can. And, if we can exceed our projections, then that's even better. So that's what I'm going to try to do for investors like Ted. But yeah, that was a great event. There were a lot of good speakers. There's real estate, macroeconomics, which I hadn't really paid much attention to since I started following George Gaiman about a year ago, and it's been super helpful. And then cryptocurrency was the other major topic that people were talking about. So, and then precious metals. One lady was talking about prepping. That was really good. Her name is Lynette Zhang, Z-A-N-G. She's fascinating. She teaches people how to kind of accumulate precious metals, prep for what could be coming in terms of a crisis, and she's teaching people how to grow food and those types of things. she was really cool. Robert Kiyosaki was there. Talked to him a couple times. Jason Hartman. Rick Roll spoke for an hour. He was fascinating. It's not often you get to hear Rick Roll speak to an audience. He's a billionaire investor. Robert Breedlove, who's one of the most respected people in crypto, or Bitcoin, I should say. He's a Bitcoin maximalist. Robert Barnes, who actually filed a lawsuit against the Fed to allow their books to be open to the public to audit, and they have never allowed that, and they just changed a rule when he filed that lawsuit that's going to make it harder for us to see their books. He's kind of they have this hashtag End the Fed. They were selling hats and T-shirts about that. Lynn Alden, she's a macro lady. Ken McElroy was there. He owns over $1 billion in multifamily syndications as a general partner. Yeah, it was a great event. Bunch of really cool people. definitely recommend. They're having one again in Houston in February, I believe, if you're into that kind of thing. It was the most diverse crowd that I've ever seen at something like this. I go to real estate events all the time, and it's mostly white men. And this is a lot, like probably 40% women. And people were from in their 20s to 80s. It was just a very wide demographic that was there. It was really cool. It's really cool to talk to some different people.
Is that that's the Rebel Capitalist one then?
The Rebel Capitalist Live event, yeah. Yeah, that was the first one he ever did. He made all of his money in events. George did. That's how he got rich. He used to do events for like 5,000-6,000 people, and then he's like, 600-700 people, that's nothing. So he did a good job, I thought. It was well done, and yeah, 700 people taking over this Hilton in Miami, where they were trying to force you to wear a mask, and nobody had a mask on. It's funny. Anyway, I digress. But cool. If you guys have any more questions, I'm happy to hang out. Otherwise, I'll let you get back to your night.
Appreciate your time there.
Yeah, thanks a lot, guys, for joining.
And you're not just limited to multifamily, you're looking at other assets like storage and mobile parks, you said?
I will, yeah. Now that we're kind of in mobile as well. Yeah. I'm looking at all three of those asset classes. I think they're all good. I like multifamily because I don't know. I just feel like there's a little bit more value there, but it's really competitive right now. So we'll see. We'll see what I find. I'm doing a lot of marketing and calling a lot of brokers, and seeing what I could do. But I encourage you guys to do the same. And if you find any deals, I'm also raising capital. I've made a lot of good contacts lately that are very interested if I can find a good deal. So that's why I'm going to continue to do these meetups and get people on board. Bring your investors, bring your deals. Let's see what we can do. Let's put something together. So, anything else? All right, guys, I'll let you go. Thanks, Ted.
Well,
Thanks, Dave. Nice to meet you, Brian and Mike. Maybe we'll do these in person. Would you guys be interested in doing a live in-person meetup at some point?
I would love it.
Yeah, me too. I'm hoping that I can get more people. I have like 68, 69 people in this meetup, but I think people are just sick of Zoom meetings.
agreed.
Yeah, cool. Maybe we'll do the next one live.
Sounds good.
All right, guys. Take care.
Same to you.
Thank you, Jason.
All right. See you, Ted. You bet.
Take care, Jason.
Have a good night, Dave.
You too.
Thanks.